Look at the real charts for Nifty, Reliance, and Tata Motors. What if I told you that market movements are actually not random at all? What if stock prices move in recurring patterns, driven entirely by fear and greed? Take a look at these completed patterns on the screen. Today, I'll explain Elliott Wave Theory in the simplest possible way, revealing the psychological map that the market leaves behind in this explainer.
Now, what's really interesting here is the paradigm shift this theory offers. We kind of have to strip away the complex algorithms, the macro data, the endless technical indicators, and just look at the raw human sentiment underneath. The stock market isn't just a math engine. It's a mirror. It literally reflects the collective hopes, fears, and delusions of millions of investors making decisions under uncertainty.
We see these primal emotions, fear, greed, hope, panic, dictating every single boom and bust. Markets don't just swing because earnings missed by a fraction of a percent. They swing because people are afraid, right? They swing because people are greedy. Think back to the COVID crash. We saw a rapid cycle of total panic, then a recovery, and finally, absolute euphoria. It's the exact same emotions, repeating over and over again.
Okay, here's our agenda for today. We're going to cover why markets move, the core 5-3 pattern, the psychology behind the waves, the rules and Fibonacci ratios, some real-world examples, and finally, the advantages and limits. Let's jump in.
Section 1. Why markets move. Let's actually go back in time a bit to see where this emotional roadmap comes from.
We're looking at a foundational discovery from the 1930s by Ralph Nelson Elliott. He studied decades, literally 75 years of stock charts, and he realized that human herd behavior creates specific, repeating shapes on all time frames. Whether it's a yearly chart or a 30-minute chart, the market moves from pessimism to optimism and back again in these naturally repeating fractal patterns.
Section 2. The core 5-3 pattern. This right here is the absolute core principle of the whole theory.
So Elliott realized these emotional cycles follow a very specific roadmap, an 8-wave structure. First, we have the motive phase, which is 5 distinct steps forward. Imagine a staircase, okay? Wave 1 goes up with initial optimism. Wave 2 steps down slightly for some profit booking and fear. Wave 3, that one blasts upward. It's the strongest trend with heavy institutional buying. Wave 4 goes sideways for more profit booking. And finally, Wave 5 shoots up one last time into peak retail euphoria.
But as we all know, markets don't go up forever. Next comes the corrective phase, 3 devastating steps backward to reset the cycle, labeled A, B, and C. After the euphoria of Wave 5, Wave A drops sharply. Then Wave B bounces back up. It's a false recovery, a classic bull trap. It totally tricks people. And then Wave C crashes down, wiping out the latecomers with true panic selling. 5 steps forward, 3 steps back.
Section 3. Psychology behind the waves. To truly grasp this, we have to look past the numbers for a second.
Because this is really about human drama. Our brains are hardwired for survival. So our neural threat and reward circuits routinely override our rational investment logic. When a stock plummets, your brain's threat detection center literally screams at you to sell and run. When it surges, dopamine floods your system, begging you to buy. Elliott Wave basically just maps those exact chemical reactions on a chart.
Let's break down the psychology of those 5 motivate waves. It's fascinating. Wave 1 is born in total doubt. The news is still terrible, but the smart money enters quietly. In Wave 2, fear is still high. The public completely assumes the rally is fake. But then, Wave 3, the absolute best wave. Institutions buy heavily, volume spikes, and momentum is massive. By Wave 4, weak hands exit. And then Wave 5 hits, pure euphoria. Retail investors rush in, the media is incredibly bullish, and everyone feels like a genius right before the top blows off.
The corrective phase is just as intense. During Wave A's first sharp decline, most people just ignore it, thinking, oh, it's just a healthy pullback. Then Wave B happens, a total speculator's paradise, a phony bull trap built on pure complacency. And finally, Wave C drops the hammer, devastating destruction. Illusions evaporate, pure panic sets in, and retail investors often sell at the exact bottom out of pure fear.
Section 4. Rules and Fibonacci ratios. Now, despite how messy emotions get, Elliott established a framework that brings mathematical structure to all this chaos. While there are plenty of guidelines, there are exactly 3 unbreakable laws. If you break any of these, your wave count is totally invalid and you have to start over. Number 1. Wave 2 cannot retrace below the start of Wave 1. Number 2, Wave 3 can never be the shortest motive wave. In fact, it's usually the longest. And number 3, Wave 4 cannot drop into the price area of Wave 1. Just 3 simple rules, but they are absolutely crucial boundaries. And here's where the magic of Fibonacci comes in. Because human psychology is fractal, traders overlay Fibonacci ratios onto these waves to find exact entry targets and stop losses. Keep it simple. A deep Wave 2 pullback often hits the 50% or 61.8% level, which is why fear is so high. A shallower Wave 4 might bounce off the 23.6% or 38.2% line. And that massive Wave 3, it often extends to exactly 161.8% of Wave 1.
Section 5. Real-world market examples. Let's see how this actually works on real charts to dramatically boost our understanding.
Look at the 2020 COVID market cycle. It is a perfect textbook example. March 2020 was absolute panic, that deep correction Wave C bottom. Then, mid-2020, smart money quietly enters during Wave 1 doubt. By late 2020, we see massive institutional buying in Wave 3. And by 2021, total retail euphoria. A perfect Wave 5 peak right before the cycle resets.
We can use this exact 5-3 structure to project precise downside targets on individual stocks, too. For example, looking at Reliance, analysts mapping a Wave C targeted a 1,340 rupee level. Why? Because that perfectly aligned with a 38.2% Fibonacci retracement of Wave 4. It's like a giant puzzle coming together on the chart.
The exact same principles apply to the Nifty 50. Because the index is so volatile, traders use these Fibonacci levels to find high-probability entries. Instead of just guessing where a pullback will stop, they locate that golden pocket during a Wave 2 to get in right before the massive Wave 3 takes off. It keeps you on the right side of the emotional trend.
Section 6, Advantages, Limits, and Takeaways. Before you rush out to chart your whole portfolio, let's get real about using this day to day. The advantages are huge. It clearly identifies the primary trend, helps immensely with timing, and maps crowd psychology across any time frame. But the limitations are very real. It is highly subjective. It's incredibly difficult for beginners to master in real time because hindsight is always 20/20. Honestly, 2 experts can look at the same chart, follow all the rules, and draw 2 entirely different valid counts.
And that is exactly why disciplined traders never use Elliott Wave alone, period. It's not a magic crystal ball. It is a roadmap that you must combine with trend analysis, support and resistance, volume indicators, and fundamentals. You use the wave count to confirm a trade idea, not to blindly create one.
All right, our final takeaways for this explainer. Markets move in predictable emotional cycles. The core pattern is always 5 motive waves up, followed by 3 corrective waves down. The 3 unbreakable rules and Fibonacci ratios give you your structural boundaries. But above all else, risk management matters far more than having the perfect wave count.
So I want to leave you with this provocative thought to analyze your own portfolio before the market opens tomorrow. Take a look at the charts today. Are we currently riding the massive institutional strength of a Wave 3? Or are we completely falling for the complacency and fatal bull trap of a Wave B, unaware that a devastating Wave C is right around the corner? Thanks for joining me on this explainer, and I'll catch you next time.